Okay, guys, so we're going to be going live. If you are on Instagram or Facebook, we will not be able to answer any questions until we're at the end of the webinar. This call or this webinar will not be recorded on Facebook or Instagram, but it will be recorded for everybody who joined us on Zoom. So if you haven't joined us, make sure to do so. And for everybody who is on Zoom, thank you for joining us. What we're going to be talking about, obviously, my name is Jefferson Ortiz, and I'm here with my partner,
John Ortiz.
And what we're going to be doing is we're going to be going over how we are planning and how you can build wealth through long-term, how to build long-term wealth by investing in U.S. multifamily. So we are just going to give it, hide this here, hide. And we are just going to get started in about 2 minutes, so we'll just let everybody kind of jump in. Everybody who is on Instagram and Facebook, remember, we are not going to be answering any questions. So if you do have questions, put in the chat or
yeah, if you're on Facebook or Instagram, if you're interested in joining this webinar, we do them once a month, and our marketing team sends an email with the Zoom link if you're interested in joining for next time and you want to have a better view of the webinar. Please make sure to join our email list or send me and Jeff a message, and we'll go from there.
Thanks. All right, so without further ado, we'll get started right away. So John, if you want to give the audience a little bit of an audience.
So we're just going to go over some of the content that we'll be touching based on, which is an introduction. If you are new and you don't know who we are, we'll be talking about a little bit about what we do. We're going to be talking about understanding passive investing. We're going to be talking about multifamily syndications. We're going to be having 7 steps to $10,000 in passive income, and the top 5 myths about creating wealth via USA multifamily, tax considerations, and at the end we'll have some Q&As and some conclusions towards the end.
Thank you for that, John. So we'll get started with exactly who we are. So who is ORTIZ Equity Group? You may be asking yourself if you don't already know us. So what we're doing right now is we are opening an exclusive chance to partake in extraordinary U.S. multifamily assets. Guided by our seasoned experts, we are a team of seasoned real estate professionals specializing in acquiring and managing multifamily properties across the U.S. We grasp the real estate investment challenges, particularly for time-pressed individuals. That's why we offer a passive investment gateway to diversify U.S. multifamily portfolio, liberating you from the day-to-day management hassles. Your precious time is yours to savor with us. Now, when we talk about multifamily, you might want to ask yourself, well, what exactly is the team's track record? That's very important when multifamily. So our team's track record, and to give a little bit of background on our team, we have John Ortiz, one of the managing partners, myself, Jefferson Ortiz, one of the other managing partners, and then we got Prashant Kumar, he's the partner and senior advisor. So our team has a collectively 50 years of real estate experience. And we have a track record of success across various industries, ranging from hospitality to technology, government, small business, and finance. So up to date, our team's track record is 19 plus deals completed to date, 5 full cycle deals completed to date, 2,486 units under management, $120 million assets under management, over 250 million in total transactions. And some of the places that we own assets is particularly mainly focused in the Sun Belt region, as you may be able to see here. North Carolina, South Carolina, New York, Florida, Texas, Georgia, and Alabama, with focusing a lot more in the Georgia and North Carolina market over the last little bit. So this gives you a peace of mind of who is the team and what is the team's track record. So we just wanted to add this here. We do, for anybody who has joined us today on the call, we are giving away a free book. And you can access and you can get this book by going into ortizequitygroup.com. And at the bottom, you'll get there the free book. It's 50 terms that you should know about real estate. Again, we just want to provide as much value as possible. So claim your free book right away. All right, so we'll get right away. We'll get rocking and rolling here. So with understanding passive investing.
Absolutely. So what is passive investing specifically? In multifamily specifically, involves acquiring ownership in multifamily residential properties such as apartment building complexes with the primary objective of generating consistent income and long-term wealth. In passive investing, individuals or entities invest capital into a real estate project or syndication managed by an experienced professionals like ourselves, such as a firm or syndicators. Passive investors typically have limited involvement in the day-to-day operations and management of the properties. Instead, they rely on the expertise of the active asset management team to handle the property's acquisition, leasing, maintenance, and other responsibilities.
Thanks for that, John. And below, we're going to be talking about what are some of the benefits of investing passively. I know a lot of people that may be on the call may be active, but we want to show you what is the benefit of passive investing. So one of the first benefits that we can think of here is time freedom. Passive investors enjoy more free time as they are not directly responsible for property management, tenant issues, or maintenance tasks. This allows them to spend time with people they love and pursue their passion. So here we have a picture of a family, and this just kind of goes to show you why we're so passionate about this.
Absolutely. I think like relying on a good team that has a good track record, that has a good deal, you've done your due diligence on, you can now have freedom. I think a lot of people that try to invest and have a day-to-day job, such as doctors, lawyers, business owners, etc., and waste a lot of time trying to handle their investment. And it's a headache. Sometimes they lose money. Sometimes they may go out there and do a flip and maybe, lose money, or just, invest overall and it doesn't go well. So it's good to invest in large syndications with, of course, the right operators and doing your own due diligence. But it is an absolutely time freedom for sure.
The second benefit we have from passive investing is diversification. So passive investors can spread their investment across multiple properties or multiple units or projects, reducing risk compared to putting all capital into a single family property, which is common in active investing. So a lot of people may get started in the single family or duplex space, but it is very much hard to scale from there, and it's very hard to be able to create a good momentum of real passive investing. So we just kind of want to share in here how multifamily can help you in diversification.
So here is something that we definitely want to express, the professional expertise, right? So finding a good team that knows what they're doing, that has a track record. And passive investors benefit from the experience and knowledge of professionals with management team who handle the property's operations and enhance likelihood of successful investments. So who's the professional expertise? Is your operators like myself and Jeff? It's our lawyers, it's our accountants, it's our underwriter,
property
management broker, it's our asset management, right? So it's a whole team. It's a team sport. It's like what we like to call it. And we rely on their expertise, they rely on our expertise, and our investors rely on our expertise to be able to deliver their profits and their investments, for sure.
Yeah, and I don't think it's as common with the single family house. In the single family house, you typically have your realtor, your mortgage broker, maybe a property manager if the property can sustain that. But your team isn't as big in the single family. I think it's more of a single journey, single person journey, as opposed to a team. And that's the benefit of multifamily, passive multifamily. You're able to leverage other people's experience, relationships, and knowledge in the market, right? So what we can think about, the next one we have here is reduce stress. Passive investors are not burdened with the stress of hands-on property management, dealing with tenant concerns, or handling emergencies, which can be common in active investing. And just wanted to kind of share a little bit of story about when we first started, one of our duplexes that we had, one of the first duplexes that we purchased. We had at the time, we tried to lease the units ourselves without using property management, without doing property diligence, and we ended up getting a tenant in the unit that ended up being a horrible tenant, to say the least. Did not pay rent, caused a bunch of issues to the unit, and it took us well over a year, and our units were 50% vacant. And then she also caused about $15,000 or so worth of damages to a brand new renovated unit. So that goes to show you how, as a passive investor, and as you invest in larger multifamily properties, both vacancy as well as capital expenditures are not such a big factor because of all the rental units that you have. So we just kind of want to share that story. Anything you want to add, John? Next one we have is
Limited liability. So passive investors typically have the least limited liability in the event of legal issues or property-related problems, through reducing their exposure to financial risk.
yeah, so something I wanted to add in here is obviously when we do go and purchase these properties, I just want to ask you some questions, John. Do any of the passive investors, do they have to qualify for the loan?
No.
Do they have to sponsor the loan? Or is their name on title when it comes to the loan?
Absolutely.
So you're telling me that I can invest passively and I don't have to worry about setting up, or getting the loan, so who typically does this?
So the person that usually sponsors the loan is one of the sponsors on the team. They belong on the team.
General partner?
What the general partners is the person that will usually sponsor the loan. And I think the word says it itself. Passive investing, it means completely hands off. You're investing into a team that's going out there and they're performing their business plan on a building that has 100+ units, and they're trying to double the value of the property. And yeah, so limited liability for sure. You know, the corporate structure that is set up between the properties, the general partners, and the limited partners, you know, are all set up there so that they have protection and we have protection.
So basically, as a passive investor, I can simply just give you my money and I don't have to worry about any corporate structure, any loans, any debt.
No, everything is set up usually way before an investment starts to open up to equity for investors.
And if the building, you know, somebody sues us in the building, do I, as a limited liability, as a passive investor, am I at risk for that?
No, absolutely not.
Interesting. Okay.
Everything is held up through very specific corporations and LLCs, and again, that is worst case scenario, obviously.
Interesting. Okay.
But no.
Okay, thank you for that, John. And then, you know, what we have here, the next point we have here, benefits of passive investing is predictable income. I mean, so here we'll go over this and I'll tell a little story time here. So passive investment in large apartment buildings in the USA, 100+ units, often provide regular income distributions, allowing investors to receive a share of rental income without direct involvement, unlike the single-family houses or small multifamilies. And again, just going back to the same story we were talking about earlier, one of our first duplexes. How much on a duplex? If you have one tenant leaving, how much vacancy do you have?
50%.
50%. So if I have one tenant that leaves my unit, I have 50%. Now, what if I have a single-family house and somebody leaves?
You're finished. That's it. You have no rental income coming in, right?
So 100% vacant. So this is why we love 100 units. With 100 units, we typically are underwriting anywhere from like 5 to 10% vacancy. So our numbers, our projections, we're still cash flowing, even with the vacancy, even with the property management, and we're still able to pay our bills and have cash flow.
That's correct. That's again, that's why we love large multifamily. And again, it's not just all the benefits that you mentioned, but it's also the long-term picture that you see later down the road, where you're increasing the net operating income and increasing the value of the building.
Okay. So that's kind of what the story is. Again, the tenant was there, she didn't pay rent, then she didn't pay for a whole year, and we didn't receive that income. Now she also managed to damage the unit, and she probably cost about 15,000. So about, what was it, like 15,000 of no income plus an additional $15,000 of damage. That's what
another reason why we invest in the US is friendly tenant and investor friendly states where you can perform this kind of business plan and not have such a headache.
When we were down in Savannah, we were talking to some of the property managers in, you know, North Carolina. We've been down there to talk to the property managers. How long does it typically take for a tenant that is not paying to get kicked out? Typically,
I believe, if I'm not wrong, in that conversation that we had at dinner, she said a month.
A month. So 30 days. 30 days. A tenant doesn't pay 30 days, you kick them out. Wow. Okay. Now, what if we want to go and increase the rent? Is there any rent control in some of these states, or
no control at all?
Okay.
I mean, you can go out there and form your business plan as soon as you take possession of the property.
Okay. And lastly,
scalability. So passive investors can scale their investments by participating in multiple larger syndications, potentially accelerating wealth accumulation. Imagine planting multiple seeds and having them all 2x every 2 to 3 years, which is it's actually a very good example. Just to give everybody an idea, the deal right now that we have in Savannah, it's something similar to those returns. So 2x and 2 to 3 years credit.
Yeah, that's typically what our projections are. Now, I guess, you know, in this, what we can definitely talk about is that it's very difficult to scale a multifamily business, 100, 50 units, 70 units in Ontario. Would you agree or disagree?
No, I agree with that.
Okay, and then in the States, right? How much, why is it easier to scale when you buy a larger multi? Are you managing the property or do you have a property management? Like, who's usually managing? Why is it easier to scale, do you think, in the States?
Well, I think it's, the regulations, right? The assets that you don't get down here, right? So you're getting, 200 plus unit assets.
Is there usually like a leasing office
There's
or?
a leasing office,
Okay.
usually on anything that's above 80 units.
Yeah,
Or so. They have their own leasing office, so they're able to operate and control their own leasing.
so the property manager is not leasing those units, they have a leasing office.
They have a leasing office.
Okay, and then who manages the leasing office?
The asset management team that's on the general partner team.
Wow,
So that's
okay.
what we do.
Interesting.
Is making sure that they're on top of their operations to make sure that we're on top of our operations and the business is going according to plan.
Interesting. So I guess to say the least, you're able to scale a lot quicker because A, you have landlord-friendly states. B, the asset itself is large enough, so you actually have on-site management. You have a property managers managing the leasing office, and then you have asset managers that are managing the property managers in the overall project. Okay, so let's say you have a 100-unit building, and the leases are coming up for renewal. As those leases come up for renewal, can you turn the leases over and increase the rents or renovate the units, or do you have to wait, give them cash? How does it work?
No, I mean, of course, there's report with every tenant, but usually it's done within the first 5 to 10 days.
Okay, perfect. Okay, guys, so last but not least, a lot of people that may be on our social media, on Facebook or Zoom, you may want to know about market access. And what does this mean exactly? So passive investors gain entry to real estate markets that may pose geographical or entry challenges for active counterparts. In our scenario, we empower Canadian investors to engage in our multifamily properties and projects, and specifically in landlord-friendly states like we've mentioned. This strategic approach unlocks exclusive opportunities that would otherwise remain beyond their reach, effectively erasing geographical boundaries. And I think this is really important to talk about, right? Just because we are based out of Canada, our firm is based out of Canada currently, and a lot of our database is Canadians. And, I think prior to kind of us going out and expanding and bringing these opportunities, I personally don't remember seeing anybody really bringing on these kind of opportunities to investors. Like I personally haven't seen. I'm sure there is people that do syndication, but I haven't seen a whole lot of people that actually bring opportunities to investors in Canada. Accredited and unaccredited investors, depending on the type of raise that it is, 506B, 506C. So that's essentially what we want to do. We want to be able to, when we're looking at deals in Canada, John, just to give the audience an understanding, were our deals cash flowing from day one in Canada?
No.
Did they ever cash flow from day one in Canada?
No.
Okay, and I think the main reason for that is because both A, the properties were too small, or B, the rents were so low in compared to the price that the sellers would ask, and the numbers actually didn't make sense. You're buying like a three cap, maybe?
Yeah, it's market rent compared to value price, right? I mean, if you've got low rent, high value, you're just playing cash.
Now, let me ask you a question. Like typically on a 100+ unit apartment building, not always, but do you cash flow from day one? Do you usually have to wait a year, 2 years, 3 years to cash flow? Do some assets cash flow from day one when they're 100+ units?
I'm not gonna say that every single one does, but our underwriting model, our business plan is to find those deals that cash flow from day one that are in B minus, B plus, either A neighborhoods or B neighborhoods where you find an asset class that is again underperforming, undermanaged, and you know that okay, I can cash flow from day one, execute my business plan, my investors are happy, and we can execute our business plan to be at the end goal, which is refi or sell and be able to drive the value of that.
So just to confirm, so some of these assets in the state do cash flow from day one.
That's correct.
Wow. Okay, that's interesting. Okay. So that is it, guys, for the benefits. Now we're going to be talking about what is a multifamily syndication and how does it work? Because I know a lot of people may be wondering, okay, well, what is a syndication? How does it work? How do I get involved? All this stuff. So that's kind of what we're going to be going over in here.
So for anybody that doesn't know or anybody that is familiar with it, what is a multifamily syndication specifically? A multifamily syndication is a real estate investment strategy in which a group of investors pool their financial resources and expertise to collectively acquire and manage multifamily properties, such as apartment buildings or complexes. In a syndication, there are typically two main roles.
Thank you, pleasure. Okay, so we're going to be talking about the first role, and is a sponsor or syndicator, which in our case is myself and John. This is the individual or company with experience in real estate who identifies, acquires, and manages the multifamily property. The sponsor is responsible for and include the following: deal sourcing, identifying and sourcing multifamily properties that align with the investment strategy and objectives, financing, secure loans and financing for the acquisition of the property, often negotiating favorable terms for the investor, underwriting, conducting a thorough due diligence, financial analysis, and risk management to ensure the viability of the investment, business planning, developing and executing a comprehensive business plan that outlines the investment strategy and property management and financial goals. Fifth, we have here is asset management, overseeing the day-to-day property operations, including tenant relations, maintenance, and rent collection. Six is investors relations, communicating with passive investors, providing updates on the investment performance and addressing their inquiries. Repositioning, implementing strategies to enhance the property's value, such as renovations or improved management practices. And eighth, but not least, we have exit strategy, planning and executing exit strategies, which may include selling the property for profit or refinancing to optimize returns. In essence, the syndicator is a driving force behind the multifamily syndication, responsible for every aspect of the investment, from deal origination to achieving the investment goals and delivering returns to the passive investors. So again, this is the sponsor, aka syndicator, which in many cases, for our cases, is myself and John and our team. Now, John, how many? So we got 8 different things, and this is not including a whole lot of other things. This is just a few of the things, right? So 8 different responsibilities for the syndicator / sponsor. Now tell the audience or tell the people listening, how many deals do we have to typically look at to find a good investment opportunity, roughly?
It's tough, to be honest with you. It's extremely tough to find a deal that is a good deal, and to be able to acquire that deal, do your due diligence on it, and make sure that it aligns with your business plan. Because even if you find a good deal and you do your due diligence and it doesn't align with your business plan, it's tough and you got to let it go. And in today's market specifically, with high interest rates, high value purchases, it's extremely hard. It can honestly be a full-time job to find a good deal.
But just a rough number for the people who are listening. How many deals before you find a deal?
I would say an average from what we've done on our KPIs is typically between 80 to 100.
80 to 100, or if not more. I mean, before finding any deals, I'd say average 150 to 200 deals at this time right now before finding a deal. So that, to say the least, that when we do find an opportunity, when we bring a deal, we have looked through a lot, and we have looked at and underwrote a bunch of deals before finding the ones, especially the ones that cash flow, right? As John mentioned. Okay, so that's all the roles again of a sponsor or syndicator. So 8 different roles, and we could probably have like 15 or 10 or 20. Now, John, if you want to tell the people a little bit about what is the second role.
Yeah, so the second role in a syndication, as we just talked about, the first role is the general partner, the syndicator, who's driving the operations of this building. And the second role is the passive investors, is the investors that provide the capital, or again, some of the capital for these deals. Also known as limited partners. These are individuals or entities, and you can also invest as an entity, who invest capital into a deal syndication, becoming a limited partner. Passive investors provide the financial resources needed to purchase the property, to have limited involvement in its management. Again, it's named limited partner. They receive a share of the profits and cash flow generated by the property without the responsibility of the active management team, which is, again, being Jeff. And again, the role of a passive real estate investor, not much. Invest capital, contribute the funds for the real estate project or syndication led by the experienced operators. Minimal management, so being relieved of property management responsibilities, tenant interactions, and day-to-day operational tasks. Income and returns. So receiving a share of rental income and profits generated by the investment, often in the form of dividends or distributions. Limited liability, typically having limited liability in the event of a legal issue or property-related problem. So some of these responsibilities for the passive investors, again, it's not much. Of course, we'd love to have our investors being involved in some of the reports, so you do get a monthly report on how the building is operating. Sometimes we'll take a trip once every 3 months with, again, it's all right. If the more
Depends how much they want to know
more
on the project.
participate.
Like we have took our investors to due diligence, right? When we're raising an equity and we're bringing our investors, they want to see the asset. We bring them through for due diligence. It just depends, but I guess the main thing with this is that you're not really doing much. I mean, you obviously you have the funds, you invest the funds, but aside from that, you just get what we call mailbox money. And if you want to tell the people what is mailbox money?
Mailbox money essentially means that you just sit back and relax, enjoy your freedom, and you get your distributions every month or every quarter, however the
So
distribution.
some people will do monthly distributions.
Some people do monthly, some people will do monthly,
Okay.
weekly, every 6 months, every quarter,
Okay.
every year. Again, it depends on the
So
step of the property.
just to do a little conclusion of this. So a active investor or sponsor is doing 1, 2, 3, 4, 5, 6, 7, 8 things, 8 roles essentially. A passive investor essentially invests and they receive mailbox money.
That's correct.
Interesting. Okay. Okay, so now we're gonna be doing 7 steps to 10,000 in passive income. And I think this is something that a lot of people, at least in Canada, they want to achieve, which is $10,000 of passive income. That's like a good number. I mean, with that number, most people can essentially retire because that's a 6-figure job. But how achievable is that in Canada? Would you say, John? With tenant turnover and everything.
It's hard. It'll take you a while to achieve something like that.
Okay. What about with this interest rates? How hard is that?
It might take you double the time.
Okay.
For sure. I mean, it could be 20, 30 years before you see something like that.
Okay, so what we're going to be going over is just a little, I guess, roadmap, how people can achieve this. And again, this is just our own kind of opinion on how you can get here without the headaches. So, step 1. So what is step 1? Step 1 is secure 100,000. So obviously, in order for what we're going to be going over, you do need to have access to 100,000. So you must either determine to create a pathway to secure at least 100,000 in capital and money. Some of the ways and some of the things we have here is enhanced financial literacy, boost your understanding of income growth in financial management. Second is capital sources, identify ways to obtain this capital, including home equity line of credit, property refinances, asset sales, or savings. Third is skill advancement. Explore a skill development options that often avenues to acquire the necessary funds. So obviously, when we started, we did wholesaling, and that was a great tool, a great skill that allow us to earn way over 100K. So that is one way. But what if somebody is a high income earner? They would maybe already have that saved up, or maybe they have a bunch of, maybe have a couple of rental properties and they could sell a few or refinance. But the main thing is secure or get 100,000. You could get borrowed from a family friend or whatever the case may be. But for this example, you must get 100K. And I think there's 2 mentalities, right? There's one, I don't have 100K, but if you simply change your mindset to how can I have 100K, then your mind will start to think and create ways into it. So step number 2, John.
Here we're going to talk about strategic investment decisions. So after securing access to 100,000, the next critical step is deciding how to invest wisely. And I think a lot of people come across this opportunity right here where they have access to their first 100,000, and they might not make the smartest decision and maybe blow it off on shopping, buying a car, or crypto or something like that, where essentially it may not be an investment, or be more of a liability. And later down the road they end up with maybe half of that lost in translation, right? So many suggest purchasing a primary residence or a small duplex. These options can pose challenges like no cash flow, vacancy, capital expenditures, Consider an alternative potential more lucrative path, which is channeling your capital into a large asset, typically a value add 100+ unit apartment complex. Here you can invest and gain insights in limited partner or passive investor, minimizing the hassle of associated with direct ownership.
Yeah, and I guess here what we want to strategically touch on is obviously you could buy a duplex, you could buy a single family house, which is what 90 or 90% of the population does. However, a single family may not, and is usually never really an asset unless you're making income for it. And the reason for that is because it doesn't produce any income. If anything, it actually takes money away from your pocket. A duplex, that could be the second option. However, like we mentioned earlier, we've had one tenant move out, we had a 50% vacancy. It's the qualifying, and that's something that I wanted to talk about. The qualifying for a duplex is a lot more challenging than it is to qualify for a commercial multifamily property. Would you agree or disagree?
Absolutely.
And why do you think that is? What do they look at when they're looking at a duplex or a single family? What do they look at? Are you looking to you, or they're looking at the asset?
They're looking at you.
Okay, and now for multifamily, are they looking at you or looking at the asset?
They're looking at the asset.
Okay.
Can that asset service its own debt?
Okay.
What is your business plan? Who's the operator?
Okay. What is the net worth, right? What is the experience? Okay, so guys, number one, secure 100K. Number two, strategic investment decisions. In our case, what we encourage and what we empower people to do instead of doing that is invest in 100K minimum into a syndication. Could be ours, could be somebody else. Obviously, in our case, we're influencing people to invest with us. But the main thing is, instead of buying a duplex, instead of buying a single family, instead of buying a triplex, why not invest as passive investors? And I think that's kind of how we got started in the multifamily. We invested as passive, got more active. So again, get 100K, invest into an apartment syndication. And step number three, expected returns. Again, guys, these are just projections. This is nothing like set in stone, right? These are just projections and just rough numbers that we're able to get from our deals and other similar assets. So now in this multifamily asset, or typically, you can typically, and that's kind of what underwriting kind of looks like, and that's why underwriting is so important. But we're typically seeing anywhere from 7 to 10% cash on cash on $100,000 investment, right? So with potential for even greater gains from equity and appreciation. We're just simply talking.
This is yearly.
This is yearly. You got it. So how does this look like in terms of numbers? So let's just say you invest into a 100+ unit apartment building, even with a 5 or 10% vacancy. It's still positive cash flow. It covers expenses and debt. Now, your 100,000 investment year over year would generate roughly, again, this is just projection. This is nothing set in stone, but this typically will get you $7,000 to $10,000 of annual passive income, right? Or approximately $700 to $833 a month. This hands-off approach leverages the expertise of an experienced asset management team. So again, you invest 100,000, and that 100,000 potentially could yield you 7 to 10% cash on cash, meaning that 100,000 would yield you $7,000 to $10,000 year over year, which translates to $700 to $833 a month of passive income. Is that correct, John?
That's right.
Okay. So that's just to give you an idea, right? Now, obviously, the more you invest, the bigger your return is, because the more you get in distributions. Step number 4, John.
Absolutely. So here we're talking about the value, appreciation, and exit strategy, which is us operators, what we call, once we have achieved our goal on our business plan, is what is the exit? What is an exit strategy? So for passive investors, the journey continues as the asset management team implements a strategic plan aiming to renovate the units, boost the net operating income while reducing expenses. Again, our goal is not just to do the net operating income, it's also to reduce expenses, to be able to drive that value, drive the cash on cash. Even typically higher than projections, right? If we're projecting 10% cash on cash, but you're getting 12% cash on cash, you're happy.
But we're just going.
Typically 50 to 75% of units are turned over, leading to a substantial
by year 3. By year 3,
an asset value. That's correct.
So by year 3, 50 to 75% of the units are turned over typically, Leading to saying, okay, okay.
At this point, the property is often sold aiming for a projected 2 to 2.5x return on investors' capital, or it may be refinanced to recover 80 to 100% of its initial investment in the first, usually between 3 to 5 is what this will do it. But if investors receive 200,000 back after selling the asset by year 3, they would have doubled their investment.
Yeah, so basically 100,000 investment would essentially turn into 200 to 250K potentially. But we're using 200.
That's where the term equity multiplier comes into play. Many of our investors reinvest their proceeds into another syndication with similar returns. For instance, if you reinvested 200K at 8 to 10% cash on cash, you'd receive an annual distribution of 16 to 20,000, translating to a monthly distribution of around $1,300 to $1,600 a month, all completely passive while we are driving our business plan and driving the value appreciation and the net operating income.
Okay, so let me get this straight. So the first year I invested 100,000, I got between $7,000 to $10,000 annual, so year over year. And then by the third year, so I got about 30,000 or so of my capital back by third year. And then at that point, we will sell the asset. And if we sell the asset, I should get anywhere from 200 to 250,000 back. Now that's if we sell the asset. If we refinance the asset and we return our investors' capital, that mean that they're off the deal, or would they still be in the deal?
No, that's an amazing thing. Another amazing thing.
Those are two strategies, right?
Yeah.
Sell and
So
refinance.
it's an amazing thing about syndication is one, you still get to keep your equity share of the building.
So you refinance, you get all your capital. So I invested 100,000. I get all my 100,000 back.
You get all your 100,000 back. And usually when we sit down to reporting financing on the building, usually it should meet around 80 to 90% of the investor's capital back. So you'd get your 100,000 back.
80 to 90 or 100,000.
Plus an additional 80 to 90,000 back.
No, refinance, on a refinance.
This is on the refi, but you still have your initial ownership.
So you would get all your initial capital you invested, but now you have no money invested into it, but you still have ownership into the asset. Is that correct? Okay. Now that's one option. Now the other option, and kind of where we're going this basis example on, is if you took that 100,000 and then in 3 years we sold the asset and our investors made 200,000. So instead of taking the 200 and buying liabilities, they actually invested because they had such a good experience. So typically our investors will reinvest with us. Now instead of 100,000, now you invest in 200,000. So now your distribution monthly is 1,300 to 1,600. I mean, that could cover our mortgage, I would say.
Oh, sure.
Okay. So that's So that's step number 4. Now, what is step number 5? Step number 5 is continue wealth growth. Now, typically we are now in year 6. So third year, 100,000 turns to 200. By year 3, this cycle continues with the execution of our business plan. After earning your annual $16,000 to $20,000, our asset management team, and again, this is not the passive; these are the asset, these are the active investors, remain hard at work. Let's say we decide to sell the asset following the strategy we've been discussing. So with 50, because typically, and the reason 3 years is because in 3 years, we're typically able to turn over between 50 to 75% of the units, just what we've been able to see. Obviously it could be a lot faster, it could be more, but typically we do 50 to 75% where we still leave meat on the bone for the next investor. And that's what I love about the States that you don't really see in Canada. In Canada, there's either no meat or there's a lot of meat, but the sellers are not. That is so now, let's say 50 to 75% of the units are renovated by year 6. Your initial 200,000 at a 2x should have turned into $400,000. So 100,000 have now turned into 400,000 in 6 years. Is that correct, John?
That's correct.
Okay. Now, again, if we do the same step that we did in step 4, in step number 4, is you choose to reinvest into a new syndication, another project, let's say that we have, because typically when we sell one, we typically will 1031 exchange or we'll buy another asset right after that. So we invest into a new syndication, but now you're not investing 100,000. You're investing 400,000, which is what you've made. Now, the returns are the same, 8 to 10% cash on cash. It should generate between $32,000 to $40,000 of annualized distribution, which translates to over 2,666 to 3,333. This is on the conservative side, right? Okay. So basically, every month you would get between $2,600 to $3,300 of monthly passive income. Are you working for this? Are you managing the asset? Are you finding the deal? Okay. Okay, but so every year you get between $32,000 to $40,000 of $100,000 investment.
Yes,
So essentially that 100,000 investment, you're making half of it in 1 year.
that's correct.
Interesting.
A young professional, a lawyer, doctor could, see this return and.
Or an investor that sold their property, refinanced
I
it.
got a lot earlier than they expected.
Okay, now show me step 6 now, please.
So here we're just gonna go about year 9, for example. Say you're here year 9 and we execute our business plan once again, while you've been enjoying the annualized distributions of 32,000 or 42,000 monthly payments. Our asset management team has been diligently working behind the scenes. Before we decided to sell the asset, following the same successful strategy. Your initial 400,000 investment has now doubled to 800,000, mirroring the partner we've seen in previous steps. Step 5, you're off to reinvest in our syndication project with 8 to 10% returns. With 800,000, this investment would generate now between 64,000 and 80,000 in annualized positive cash flow distributions and monthly payments of. If we're looking at monthly distributions, you're looking at 5,000 to 6,000. This passive income continues to grow, allowing your wealth to multiply significantly. And this is why we preach multifamily apartment syndications in the US, especially large ones, because it's so many.
And you're able to, I think the biggest thing is you're able to execute your business plan. That's the big thing, right? If you buy an asset and you can't turn over units, you can't execute your business plan if your business plan is a value add. Right? So you're telling me, so John, let me get this straight. So year 1, I invested 100,000. By year 9, that 100,000 would be giving me between $5,333 to $6,600 of monthly income. Now, would you say that alone could cover most, if not all people's, at least half of their bills?
Oh, I think it'd be, in Jamaica, that's sipping on pina coladas.
Depending on obviously your budget and what your expenses are, but $5,300 to $6,600 a month of cash flow, true passive income, because they're not involved in the day-to-day, they're not doing, looking at tenants, looking at leases, they're just at home with their family enjoying this. Is that true? Yes. Okay. Now, last but not least, drum roll. Step number 7. All right, so you are now in year 12, right? Fast forward to year 12, and we've executed again our business plan 1 more time. So this is a total of what, 3 or 4 times, I guess?
That's gonna be the 4th.
4th. Okay, so 4th time executing the business plan. So while you've been enjoying your annualized distributions of $64,000 to $80,000 and monthly payments of $5,300 to $6,600, our asset management team has been continuing their diligent work. Following the pattern, let's just say we sell the asset once again. Now, your initial $800,000 investment has not doubled, and it is $1.6 million. I'll repeat that. Your $100,000 investment has turned into $1.6 million. Now, the cycle repeats. Just like in step 6, investors are happy. Let's just say, whoever is investing, they're happy, they love it. They're like, I want to do this again. They take the same step of investing all the proceeds, $1.6 million, into a syndication with the same returns that we've been doing every single time, 8 to 10% return. At $1.6 million, you're generating $128,000 to $160,000 of passive income. Would you say that's somebody's salary?
I would say most of Canadian salaries for sure.
I don't even know most. I think it was a small percentage, 120 to 160K. That's a significant.
Oh, you're not talking about the 64,000.
No, I'm talking 120 to 160 of annualized monthly income. Now, what does that look like in terms of monthly payments? Okay, you invest $1.6 million. You are receiving $10,666 to $13,000 of true passive income. This passive income continues to multiply. Make more from your investment than from your job. Congrats, you are financially free. In 12 years, you did what takes most 20 to 30 years. Because some people might say, well, John, it's 12 years. That's way too long, right? Now, how long?
I would say it's an understatement most.
No, but I'm just saying, right?
Most 20 to 30 years. Like, I mean, some people, retire with little to no savings, right?
Okay, but tell me now, John, some typical, some regular person working a 9 to 5, bought liabilities, never bought any assets. When are they typically retiring? At what age? Would you say?
Right, 66, I think.
66? I think that is the average retirement. Now, typically, are they retiring with $10,000 of passive income per month?
Definitely not usually on a pension.
What does a pension usually look like? I mean, I don't know. What would you say?
$1,000?
$1,000
$1,500?
in 12 years, you can make $10,000 or $13,000. Now, again, what happens do you think by year 15 that 1.6 million would have turned into what is that, like what is that? Do that.
It'll be at least
Do that. I'm just
the 1.6 on another.
times six. So $2.4 million would have turned. Are you sure? Let me do the math. Let me see. Just do 1.6 times 2. 32. That's what I was gonna say.
Yeah.
So 1.6 million turns after 3 more years turns into $3.2 million. And I don't even want to go into it, but what does that look like per month? Again, guys, this is why we love multifamily. This is why we're obsessed with it, because we are able to help people get to here. This is our goal. Our goal is not for you to come and invest 100,000 and make X amount. Our goal is for you to, in 12 years, be financially free, make $10,000, $13,000 of passive income, have wealth for your kids. Like, this is something that you can invest in again and pass on to your kids. Like, you're truly building wealth. You turn 100,000 and you turn it into 1.6 to $3 million. This is only, I don't know any other business that allows you to do other than multifamily real estate, specifically in the US, where you are in control of the rents. So there you have it, ladies and gentlemen, from 100,000. And that's why it's so important to be able to secure 100,000. Most people will say, but I don't have that kind of money. But you do. If you look around and you start asking yourself how, you will come with it. 100,000 can turn into $1.6 million. There you have it. Okay. Now, time for a little bit of the fun, right, John?
Yep. So we're going to talk about the top 5 myths about creating wealth in the US multifamily.
Can I, John? Myth number 1, John.
It requires a lot of huge capital, which is not entirely true. You need to be a millionaire. We'll show you how to start with a reasonable sum and grow it substantially over time, which is what it.
Yeah, so 100,000. I mean, typically, right? Typically, what would you say people would spend on a car? On a brand new car, right? Like typical rent. A rent 400.
30 to 60,000.
60,000 on a car. And then a wedding, typically.
Probably, that depends. I'd say between 20 to 50,000.
So between your car and your wedding, you have 100,000. But are they assets or liabilities?
Liabilities.
So before you even started, so married, car, 100,000. But most people tell me they can't get 100,000 to retire in 12 years.
No, I mean, again, on a case by case basis.
Of course, right? Guys, I'm just checking my Facebook, Instagram, and we're live on everything here. So, okay. So that's the first myth that we have. Myth number 2. Active management is the only way. The truth is, active management can be time-consuming and stressful. The reality is that passive investing allows you to enjoy more quality time with your family and loved ones while your investment works for you. So I just wanted to share a quick story here, as you can see there. A quick story of a building that we were actually going to purchase, or we pretty much ended up purchasing it actually. And it was a seller, and he was getting with a hard time to sell the property. He didn't really, understand us on the price. We were kind of having a little bit of difficulty when it comes to the price. And, with us, it's all about getting to know the seller, getting to know what their situation is, how can we help them. And when we got deep, he had a kid in the car. And when we asked him about his kid, we talked a little bit about his kid. He said that his kid had said to him, I want you to love me like you love the tenants. Because it was one of these mom and pop, dads and moms. So they're always, handling the property, cleaning the supplies, making sure the leases, the tenants. So they were like a mom and pop, so they were owning the property. And he said to us that, basically we wanted to do is sell it, but he wanted to do, like, that's when we got seller financing on that building, right? But that's just to give you an example of most people's lives. Most people don't even buy multifamily properties or rental properties. The ones that do, it becomes a job, and you become slave to that job. But with passive investing, especially in large multifamily properties, you don't have to do this. You just have to do what you keep doing. You know, if you have working 9 to 5, if you have your business, whatever you do, and just allow your money to work for you. So, myth number 3, John.
Here it's, most people say it's too risky, but the reality is a real estate investment offers the stability and predictability if you know how to do it well. Disposable of most misconceptions that they are excessively risky and guiding effective risk management. The true risk lies in navigating life like a game of Monopoly without ever making a real investment.
Ooh, I like that. I like that. Okay, so Monopoly. What happens? What happens if you play Monopoly and you don't buy anything?
You end up in jail, right? But you end up losing.
You spend all the money on rent and
Yes, that's
I would personally say, especially in this day and age, that a bigger risk is never investing. And the reason I say that is because, you know, most people that work a 9 to 5, you know, they're trying to get a raise in their job, right? Let's say the raise is what, like 1-2%, but inflation is 8-10%. So I personally feel like if the riskier part is, you know, depending on a pension or fund or RSP or, you know, waiting for the government to take care of you, you're going to be in big trouble because inflation is off the roofs. And, you know, what milk costs today in 10-15 years, like it costs the same. It's going to go up, right? So I personally feel like it's riskier to not invest than it is to invest, especially in multifamily. I mean, if you're talking about crypto, you're talking about stock market, you're talking about things that you don't have any control over, that's a different story. But we're talking multifamily, physical assets, you know, real properties that people are living in. And I think one thing I wanted to add, I think John can agree with, is the reason why we decided to go after multifamily is because we're providing shelter, which is one of the necessities of a human being: food, water, shelter. So that's why we're so bullish on multifamily real estate. And as you know, America is becoming a renter's nation. Number 4, limited access for Canadians. The truth is that Canadian investors are already actively in the US real estate market. However, what sets us apart is our ability to bring you exclusive deals that were previously unavailable, like I mentioned. Truly breaking down the borders and opening up new opportunities for Canadian investors. And I think this is something that we've talked about quite a bit, is that I personally don't feel like there's anybody out there doing what we're doing. You know what I mean? Like bringing really good opportunities, 100+ units, cash, you know, like everything. And so that's why we pride ourselves in not only Canadians, but Americans as well. Myth number 4, John, please.
So here we have a slow wealth building process. One thing we love about multifamily is that you're allowed to control the value of your investment. So the complete myth for sure. Strategically, many people take decades to retire, if they ever retire at all. In comparison to the right strategy in US multifamily investment, you can achieve rapid wealth growth. This approach has the potential to transform a modest initial investment into a significant passive income in as little as 12 years. I think you just saw how $100,000 can make you 1.6 in just a couple of years. And offering a quicker path to financial freedom rather than traditionally retirement planning. And Jeff, what do we hear all the time in movies, in interviews and stories? It's the most wealthy people in the world own real estate or are investors in real estate.
Absolutely. No, absolutely. You nailed it right on. And I think it's really important for folks to understand that, you know, this is not a get fast scheme. This is a get quick for sure type of roadmap here that we've laid out for folks. And like we mentioned, you know, there's a lot of people, I'm sure you can think of your mom, dad, parent, uncle, whatever, that, you know, they've been working, they're 40, 60. I mean, especially nowadays, you see a lot of people in Walmart, McDonald's, older people, right? Like people beyond their 60s, because their pensions, their retirement, they can't last. So we encourage folks to think beyond now and think to the future. All right. So last but not least, questions. So we are actually going to take some questions, John. So I'm going to check Instagram. I'm going to check Facebook. And yeah, if you want to check Instagram or Facebook, actually, I'm going to check Zoom, see if anybody in the chat has any questions. I know we've been going over a lot of information. Where's the little... Okay, so we got two. Okay. So do we have any questions, guys? If not, I will move forward. If you guys have any questions, put it on the, is there any questions on Instagram?
No,
Is it?
so far.
We'll open up to questions. If anybody has any questions, anybody wants to learn a little bit more. If not, we'll move it on right along. Okay, so taxes, John. I know we get a lot of questions about taxes and how taxes work for Canadians that want to invest and so on. So taxes when investing in US as a Canadian. Below you'll find a graph. We've consulted with experienced cross-border accountants to illustrate the most effective approach for passive investment in the USA. Please know that while we provide valuable insights, we are not CPAs, so it's advisable to seek legal advice for your specific circumstance. And we're not going to spend a whole lot of time on this, but the main thing is that as a Canadian individual, when you invest with us, we typically will have a limited partnership. The limited partnership will then invest into the LLC. And then when that's how the money goes into and there's obviously a lot more stuff like PPMs, agreements, you know, a whole lot of stuff. And then when the money is distributed back, it goes from the LLC to the limited partnership to the Canadian individuals. When it comes to taxes, the way it works is that the Canadians will file a foreign tax in the US, and any tax that they get charged in the US, they will actually get a credit when they file their own personal or corporate tax in Canada. As most people know, or as we know, the CRA, the Canada Revenue Agency, they don't recognize LLCs. Is that correct, John?
That is correct.
Okay. So we're not going to spend a whole lot of time. If you want to learn more, you guys can schedule a call with our team and we can go over this in depth. Okay, so last but not least, we are going to be scheduling a few calls with investors that want to know what deals, what we got going on, what, you know, how they can participate into future deals. Now, our time is very limited, our schedule is very limited, as we're actively right now, you know, with calls and whatnot. So it is very limited. So if you do want to schedule a call with our team, you can visit ORTIZ Equity Group, but again, I don't know when our next appointment will be available because our schedule is filling up pretty fast. So the next available call might be in a few weeks or a month, depending on how everything goes. Okay, last, we just wanted to leave you guys with a quote here, a couple quotes for those that are scared or that are afraid to take action. Your future is created by what you do today, not tomorrow. Robert Kiyosaki. Beautiful. And then the other one, John?
Do something today that your future will thank you for.
You want to read that again?
Well, thank you.
No, the whole thing.
Yeah, was that the same one you read?
No,
It was a different one. Yeah, kind of sounds similar.
Okay, read it.
Do something today that your future will thank you for.
And with that, we wrap it up, guys. So that is it for tonight's webinar. Thank you for joining us on Instagram, Facebook, Zoom, wherever you joined us. This is another one of our webinars. And this is, again, guys, why we're so passionate and love the USA over Canada and over a lot of, and why multifamily over any other asset class. So if you guys would like to learn more, you guys can visit ORTIZ Equity Group. That is ORTIZ equitygroup.com to learn more. And this recording will not be available for anybody on Instagram or Facebook. So if you do want the recording, you will have to join our investment list to get this and also a copy of the free book. Take care, guys. Anybody on IG, take care. I don't want to save that video. I'm not gonna. I'm not gonna let you out anyway. Same thing on Instagram, on Facebook, guys. If you guys want to learn or participate in future projects, visit ORTIZ Equity Group as we wrap up here our meeting. Thank you for joining us, and we'll see you at the top.